So thank you for this introduction. Always good to be in Geneva. I was born in Geneva, but I got my education in the Netherlands, so that's why I have this funny accent. But it's always good to be back. I've been a private investor in resource companies since the early 2000s, and when I was invited to do a talk, to do a keynote here, I was looking into my first publications in the world of gold, silver, natural resources. I've been a journalist in the 1980s and 1990s. Started writing about gold in the early 2000s. Let's see, early 2000s, that was here, 2002. I started to invest in gold myself. I started to advise people to invest in gold and silver because we had this very low valuation after this correction, which took almost 20 years since the 1980s. And when I was looking in my old archive, I found my first columns is in Dutch. I don't know if you can read Dutch, but this was all printed in 2002. And I even wrote 3 columns on the manipulation of the gold markets by JP Morgan and their friends on Wall Street. And you know, I was called a conspiracy theorist for, I think, well, over 15 years, claiming that the gold market was being manipulated. And sometimes you only have to wait 17 years before the Financial Times agrees with you and, well, publish news facts like this. So I've been around for quite a long time. I'm getting old. I started the Commodity Discovery Fund in 2008. After being a private investor. In 2005, I was a market commentator working for Dutch TV, but I was a private investor at night, one could say. Yeah. Oh no, he's warning that the battery is running low, so it might be good to plug in. Okay. Well, I hope we'll have enough battery life. So in 2005, I was still working as a journalist, but I started to become a discovery investor. I call myself a full-time discovery investor. So I was always on the hunt for the next big discovery. Even started a discovery alert service for investors around that time. We had 1,000 subscribers in 30 countries. Well, alerting them about the next big discovery. We had a tip about Aurelian resources, which made a remarkable discovery in Ecuador. I always like this quote by John Bridge, a gold analyst of JP Morgan, explaining what can happen when you're lucky enough to invest in an exploration company making a wonderful discovery. I was a very early investor in Aurelian resources. One could call it beginner's luck. I bought 10,000 shares for 30 cents in 2006. It ran up to $43 within 18 months. And actually that was the start for me to become a full-time discovery investor. Keith Barron, the chief geologist with Aurelian Resources, he's very happy here because he, in his discovery hole, it was 250 meters, 5 grams of gold. It delivered 12 boxes of visible gold, and that hole was later repeated by an even better hole, I think 230 meters of 8 grams, and then 200 meters by 24 grams. And the Fruto del Norte deposit in Ecuador, being discovered in 2006, is being developed now into a mine. Here's clear evidence that under the rainbow there's a pot of gold. This deposit, so this picture is from around 2007. Currently the mine is being built and will be commissioned, and production will start later this year. So it took them 13 years to get into production, and Ecuador is one of the new countries where many mines, I think, will be built in the next few decades. We've seen an inflow of major companies like BHP and some other large producers entering the country, opening a country office and expecting to find a lot of, especially copper and gold there. Okay, now we have power, but now we seem to be stuck. Okay, there we are. So the Frutal del Norte deposit, which I just showed, will be the first large-scale gold mine in Ecuador. So that's a big success for London Gold. So London Gold, of course, bought this deposit from Kinross. Kinross bought it in 2008 for $1 billion, and Lundin Gold only paid $250 million to acquire it. As discovery investors, we focus on the sweet spot while a junior exploration company makes a discovery. That's often the best point to start an investment. And there's another sweet spot that's once the development stage turns into the production stage. It tends to be a re-rating once a company starts production. The worst decision of my life was to start my commodity discovery fund in 2008. It was just at the top of the last commodity cycle. So we see the commodity index. It had a double bottom around 2000. Took 3 or 4 years. Then we had a huge run towards 2008. Then the Lehman crisis, the collapse, the recovery in 2009, 2010, which brought us returns of 400%. And another bottoming phase, which seems to be happening now, triple bottom, also around 3 or 4 years. And I think this is one of the best times to invest in natural resources and commodities. So I should have started the fund here instead of there. But currently we have 60 million assets under management, so I think that's a great start at the bottom of the cycle. And when we look at the growth of our fund, we've been very lucky to see net inflows every year. It's quite rare for commodity funds to have net inflow every year. Especially the last few years have shown large redemptions, especially by institutions from commodity funds. I think this is the most interesting slide I can show you today. It's the valuation of commodities compared to the other assets, let's say the S&P 500. Mm-hmm. And this chart goes back 50 years, and the current valuation, one should say undervaluation of commodities, in relation to the S&P 500 is amazing. Never has been any lower than this. And I think even this week we're seeing new lows because the S&P is jumping quite a bit because of all the new QE money being pumped into the system by the Federal Reserve, telling us it's not QE, but it's 100 billion a day. So I want to touch on the extreme undervaluation in our sector. We've been investing in we concentrate on the largest mineral discoveries worldwide, and these are 2 of the best discoveries of zinc. Tinka zinc discovery in Peru, currently valued, the whole company at 40 million Canadian dollars. And if we look at 5-week zinc project in the Yukon in Canada, I think Teck already has a 10% stake in that company. You can buy 5-week zinc for 20 million Canadian dollars. Both projects have billions of metal value, gross metal value, and an NPV of around 1 billion. I think this can't get any more extreme. We have a quite simple strategy. We only invest in the largest discoveries, the world-class discoveries. And our exit strategy is even more simple, just wait for the buyout. And we've had 57 buyouts in the last 11 years. So once you choose the best discoveries, they will always be bought out by major companies looking for new projects, new reserves. And especially this year was quite strong year for us, but it's rather constant, the number of buyouts every year. We tend to focus on precious metals because I always wanted to invest and to start a fund which is also crisis-proof. So 70% of our investments are precious metals related. 20% is base metals, especially copper, nickel, zinc. We'll touch on that a little bit more later. And we have some 10% in specials, what we call specials. Could be uranium, lithium, or cobalt. We organize a discovery day every year in Amsterdam, in which we invite the best companies working on the world's best world-class discoveries worldwide to present. This April we had Quinton Henning, Keith Barron, who was the geologist who made the Frutal del Norte discovery in Ecuador. And next year we'll have another 8 companies. You're always welcome to visit that day. When we look at the number of discoveries being made in the last decade, well, there are almost 1,000 discoveries being made, but not all discoveries are equal. So we concentrate on the world-class discoveries, and if you look at the tier 1 discoveries, only 15 of them were made in the last decade. 4 being in China, 4 in Canada, 2 in the US, and 2 in the DRC. NextGen's uranium discovery is one of them. That's a large position in our fund. In the last decade, 65, sorry, that's the wrong one. In the last decade, over 60% of all discoveries were made by junior exploration companies. So many major producers have even closed down their exploration divisions. So they always need to buy out the junior exploration companies making discoveries, and that's the nature of our industry, and I think that will become even stronger. I would like to touch shortly on the very strong supply and demand fundamentals, especially the next decade. If we look at total yearly world gold production, currently around 100 million ounces, total yearly world gold discovery around 25 million ounces. So we've seen a decline in the reserves by major gold producers in the last 5 years by 26%. And it will be very hard for the industry to keep adding to their production and keep adding to their reserves. Silver is even more serious. We've had production production deficits for the last 60 years. In every year, worldwide silver production couldn't keep up with the total physical demand. And the only reason we don't see any physical shortages in the market is because we had this above-the-ground silver stock of all the old silver coins we used in the 60s and the 70s. But one day, this above-the-ground stock will be gone. We did an in-house study on supply and demand looking 10 years out. Here's the example for nickel, already in production deficit this year. Will grow. Everybody's talking about lithium and cobalt for the battery metals and the EV revolution, but often 70 or 80% of the battery contains of nickel. Nickel stocks in London are getting to a critical level, so that explains why the nickel price has been quite strong in the last year. Zinc prices have been very depressed. Zinc is getting into a situation where we see a production deficit as well, and going out a decade from now, these deficits will increase. Zinc stocks are being depleted as well in London, so that's a very interesting situation, and I think the current move by zinc, by just going up 6-7%, I think we've seen the corner, we've turned the corner and seen the bottom. Palladium, very interesting. We've seen production deficits since 2012, so this is the first metal in which we really see a physical shortage developing in the metal markets. This shortage can become quite severe and can even lead to a crisis, especially for the car makers who use palladium for the autocatalyst. That's the reason why palladium prices have increased from over $400 a few years ago to almost $1,800 now. And this clearly shows what happens when the physical demand is overwhelming the paper supply. As you might know, Wall Street is in control of many prices of many metals by selling paper shorts. So that can get very interesting. Platinum, there's no deficit in platinum yet, but they could develop in the next decade. We need platinum for the fuel cell cars, the hydrogen cars. There's platinum in each and every fuel cell, around 1 ounce per fuel cell. So that can get very interesting in the next decade, because the predictions are we will see quite a number of hydrogen fueled cars. Then if we touch on shortly on copper, in the next 26 years, the world is going to mine and consume as much copper as we have been mined in all of history. So we need to find one new Escondida every 15 months now, and Escondida is the largest copper mine and by far the largest producer of copper. And we don't find a new Escondida every 50 months, as you all might know. So if copper prices don't go up a lot, this will be there's our prediction on supply and demand for copper. And the last slide, I wanted to end with the best discovery out there, gold discovery by Great Bear Resources, finding a wonderful system in the Red Lake district. And this is the largest position of our fund. And thank you. I think it's time for coffee now. Thank you.